It is No Lazy Money right here on 760 WJR. Our friends from Peak Wealth Management, Nick Hopwood, the president, Jim Pilat, the vice president. Each month we come to you with some of the financial topics that you need to know that are concerning to you. We have solutions to some of these problems. PeakWM.com/WJR for more information. Again, tonight, we will be talking about Roth conversions, mortgage payoff. SpaceX went public. Can you believe it? What's happening with that? And a mid-year check-in review. It's all coming up tonight right here on No Lazy Money on 760 WJR with Nick Hopwood and Jim Pilat from Peak Wealth Management, PeakWM.com/WJR. And we welcome in Nick Hopwood and Jim Pilat from Peak Wealth Management. Gentlemen, happy summer to you. I feel like this is a tremendous time of the year. And America 250, happy birthday, America.
Yeah, it's the best time of the year for sure. Here we are on July 1st. Good evening. We're glad to be here, Ryan. Thank you. And we are here starting the second half of the year here. So it's the first day of the second half, first day of the third quarter. So I like that topic of the halftime review.
The mid-year review, Jim, always important. We'll get to it in just a little bit, but here we sit midway through the year. It's a crucial time financially that people can look at their own total picture.
Yeah, absolutely. So every once in a while we need those some sort of milestone to help us use it as a check-in, and the halfway point is a great opportunity to do that.
No doubt. All right, so gentlemen, I first want to talk about Roth conversions. And we are always trying to beat the tax man in our house. And I know you guys are too, legally, obviously. But there are certain ways to do that. Can you talk to me about some of these Roth conversions?
Well, you can refer to me as Mr. Roth from here on out, okay? Because I'm a big fan of Roth 401k, Roth IRA, backdoor Roth IRA, and Roth conversions. And so I think there's an opportunity for many folks out there, not everybody, but for many folks to do Roth conversions and lower their lifetime tax and also have a tax-free inheritance for their heirs.
Can I just stop you for a second there? Because as we call you Mr. Roth, for some of our listeners who may be asking themselves, why do you always prefer Roth? What would that be? What would the answer to that be?
Well, I wouldn't say that we always prefer Roth, okay, but we always want to keep that top of mind.
Lean towards, perhaps.
Yeah. Maybe not always the default way to go, but for younger people, I would say that it should be the default way to go. If you're in a super high tax bracket, maybe we want to consider the pre-tax traditional 401k in those high income years. But the name of the game is lowering your lifetime tax.
So if you are a recent college graduate and you are starting your first job, maybe you're absolutely opening up a Roth IRA.
No doubt. If I'm in the 12% tax bracket, 22% tax bracket, maybe even 24%, I really want to go heavy Roth.
What about these conversions, though? What is the benefit there tax-wise?
The idea is that if you are, let's say you're in the 37% tax bracket today and you're working with a high income, you're writing that off in your pre-tax 401k. And maybe when you're retired, between retirement and required minimum distributions, or maybe between retirement and Social Security, you're able to do Roth conversions at maybe 12% or 22%. And so if you're deducting at 37, we have a really great tax arbitrage opportunity.
Jim, talk to me about leaving a tax-free inheritance. What does that mean?
Yeah, I think that's one of the overlooked things from it as we talk about lifetime tax and total tax and everything. But when inherited money gets passed on, when your IRAs get passed on, the type of money that it is how it gets passed on to the new heirs. So if it's pre-tax money, now they're responsible for paying tax on those withdrawals. If it's Roth money, which is tax-free money, that money passes on to the next generation tax-free. So their withdrawals are tax-free. Can be a real problem if you start looking at, maybe some people are inheriting money, parents pass in their 80s, they're in their 50s and making a really good income themselves, and now having to drop a significant IRA on there, which now new rules means it has to be depleted within 10 years, can drastically increase the amount of tax they pay on their personal money and those inherited withdrawals. But if it's Roth money, it comes out tax-free.
Some of these situations that you're describing could be financially crippling or just so incredibly negligent to I see you smile there.
It could be a stretch saying negligent, but it's certainly something where we could help optimize.
Yeah.
Right? Like inheriting a traditional IRA worth $1 million is a great thing, right? But if it were Roth, it would be incredible, right?
Yeah, and so, but it feels like you without some of these tweaks and without putting your money in the proper kind of channels, you are really opening yourself up to the tax man.
You are. So Ryan, imagine you're in your prime earning years, and your parents, like Jim was saying, your parents pass away. You receive this big IRA, and maybe you're already in the 37% tax bracket, and now you have to take out $1 million over the next 10 years, plus the earnings on that account. That's all coming out at 37%, whether you like it or not. There's no way around it.
Avoiding the RMD tax bomb.
Yeah. Yep. So if you do a lot of these Roth conversions between, say, retirement age 62 or 65 and the RMD age of 75, you could do a good job depleting your IRA. And therefore, you have a smaller required minimum distribution at age 75. Now, if we don't do any Roth conversions, many people get stuck taking out massive RMDs that they don't even need. And so they're paying huge taxes on that money. And if it weren't for the RMD, they wouldn't be taking it out at all.
When you have a client come talk to you about this, are they what kind of questions are they asking about moving money and conversions and everything like that? What are they asking you? What would their concerns be, I guess?
Ryan, sometimes people are just really frustrated because they say, what do you mean I have to pay all this tax? And by the way, they get pushed into a higher tax bracket.
Right.
What do you mean I have to pay all this tax? I did the right thing. I signed up for the 401k when I was 25. I maxed it out. How could this possibly be? Because remember, when you were a kid, the older guys were telling you, sign up, max out. You got to do this. I wish I would have. And now this is our reward, this tax bomb.
It's a really tough pill to swallow for people. I have to imagine there's a lot of anger out there too.
Yeah, I think most people spend their whole life trying to figure out how to not pay tax now, and they want to defer and defer and defer. And while that feels great at the time to get a tax benefit, as a long-term strategy, it's not always your best option. We talked a little bit about making Roth contributions. If you're young enough, and even if you're in a high bracket, there's times where it can make sense to make those contributions as Roth, because you got to remember all those earnings are tax-free forever. If your money's going to double every 10 years, would you rather pay taxes on, 10,000 or 10, 20, 40, 80, 160?
Right.
You know what I mean?
It's an interesting way to look at it. We are talking to our friends Nick Hopwood, the president, and Jim Pilat, the vice president of Peak Wealth Management. You can learn more about these gentlemen at peakwm.com/WJR. There's a free offer here. Email Nick at peakwm.com to get your free Roth conversion analysis. We're excited to share that with you. Again, Nick's email is nick@peakwm.com. And you can even email Jim as well, I hope.
Go for
right?
it. Yeah.
Jim. It's a tough email.
You remember.
It's
yeah.
Jim@peakwm.com. All right, gentlemen, welcome back here on 760 WJR. We're talking to Nick Hopwood and Jim Pilat from Peak Wealth Management in Plymouth, Michigan. And we have this financial show each and every month. I don't believe we've ever talked about this particular topic, and that is to pay off your mortgage or not pay off your mortgage. To pay off or not pay off. What is the guidance there, Nick?
Well, a lot of people think it just depends on the investment returns. They say, oh, I can make 8% or 10% in my portfolio, and my mortgage is less, so I don't want to pay it off. But I think there are more considerations to make because, number one, those investment returns are not guaranteed. The mortgage rate is guaranteed, right? Now, in my case, I have a 3% 15-year mortgage that I'm like 5 years in on. So I have 10 years left. I'm 47 years old. I'm in no rush to pay it off because, it'll be paid off before retirement. It's a super low rate. I'm good. Now, if I had a 30-year and I was at 7%, which unfortunately a lot of new home buyers
Especially
are,
now, yeah.
I would feel much differently because I don't plan on working until I'm 77.
Right.
And a 6% guaranteed return is not so bad.
Yeah, I think that's an important way to look at paying off that mortgage is whatever you pay against that is your guaranteed return. So if you are in a high mortgage rate right now, especially I should say, if you're in a high mortgage rate, we can really make a case to maybe divert some of those extra dollars towards paying that off sooner.
Yeah,
especially if you're early in your mortgage.
It absolutely feels like that one is just so dependent upon where you are in your life and what kind of mortgage rate you're sitting at. I have a mortgage rate in the 3s as well, and it's one of the reasons why I don't want to move.
Yes.
I mean, I wish I could take my mortgage rate with me.
That would be great, wouldn't it? Let's talk to the Congress.
Right.
Let's get some new regulations going here.
Yeah. But again, this is an idea that so many people are faced with, and it's a good problem to have, by the way. If you are able to pay off your house, that's a good problem to have.
If a client comes and says, Nick, Jim, I really want to take money from my bank or my brokerage account and pay off my house, I would never say no or
Right.
caution them against that. I believe it's always a good thing. Like adding money to your investment account is a good thing. Adding money to your mortgage principal is a good thing. Let's do both. You don't have to do one or the other. But there's also intangibles, right? How long are you going to be working? Let's put together a plan. Let's say you're 47 like me with a 30-year mortgage. Let's put together a plan to make it an 18-year mortgage.
Right.
So it's gone by 65. And by the way, when you make extra payments like that, you are buying down your interest rate by definition because you're paying less interest. You're also accelerating the amortization tremendously. You also can skip that extra payment if times are tough. So there's a lot of benefits with having a 30-year and paying extra. I think it's a good way to go to have it timed with the timing of retirement.
Is this, from the clients that you see, is this a big topic of conversation a lot of times, or is this a big consideration for people?
I would say, yeah, I think it comes up frequently. People with the low interest rate mortgages, maybe they feel some pain about having that debt hang over their head and they want to pay it off and they want some assurance that it's not a bad thing to do. I think a lot of times this conversation always comes down to math in people's mind, right? But it's not only a math question, right? There's a ton of peace of mind that comes with owning your house and not being in debt. People always overlook risk when it comes to debt. You have a mortgage and you lose a job. Now, all of a sudden, you still have a payment that's there, right? So there's risk involved with carrying debt. So I think there's a lot of reasons, to consider paying off regardless of the math.
The psychological piece.
Exactly.
We always talk about it with money, too. If you've got debt that you can pay off, to put that into a good debt bottle and, over here and really understand. I mean, that takes really a discipline, too, to understand that's kind of a good debt, perhaps, could be potentially that you have. It's not like credit card debt where you absolutely would want to pay that off,
Absolutely,
right?
yeah. Now, here's another thing that people overlook. Now, in retirement, right, we keep talking about getting it paid off before retirement. And here's the reason why. If we have just $1,000 a month payment, and most mortgages are more than that now, right? But every $1,000 per month requires a $300,000 portfolio to kick out that payment, which is like a 4% withdrawal rate, right? That's the classic start of retirement rule of thumb. And that's not even accounting for taxes, right? Because if it's an IRA, we have to do withholding, right? And so you're actually not getting the full $12,000 per year from a $300,000 portfolio net. And the mortgage payment is net, right?
That's incredible to think about it in those terms, too. And a lot of people, you obviously would ideally like to have your house paid off by the time you retire, and to match up that math is something that people try to do as well. Hey, I want to work till I'm 62 or 65, and you might even push that out a little bit further until you retire, no?
Sure, you could. I just think that, like Jim said, the peace of mind and the risk of leverage should not be overlooked, okay? Because a lot of younger people are trying to invest in real estate using leverage, but that's how you get sunk, okay? I remember in 2008, right, we had a bunch of rentals coming into 2008. All of a sudden,
and that was a huge boom and bust.
Yes, right. I mean, Ryan, the properties are down by half.
Yeah.
Right? You're underwater. The tenants aren't paying because they're out of work, and I'm stuck. Okay, now my income is down by whatever percentage because the market was down. So that was very stressful times, and I came out of that a big Dave Ramsey fan about the debt snowball, and the first thing I did when everything rebounded was pay off all those mortgages as soon as I could.
Right. It's a wise way to do it. And you are listening to Nick Hopwood, the president of Peak Wealth Management, and Jim Pilat, the vice president at peakwm.com/WJR. There is a free offer. You can email Nick at peakwm.com. You're going to get a free Roth conversion analysis. Say you heard the show here on 760 WJR, and they're going to get you that free analysis. Jim's email is jim@peakwm.com as well. Welcome back here, 760 WJR. We're having some fun. It is No Lazy Money with Nick Hopwood and Jim Pilat of Peak Wealth Management in Plymouth. peakwm.com/WJR. Gentlemen, some news was made over the last couple of weeks. SpaceX went public, an IPO, a record IPO. Everybody wants to get in right away. Let's get in and have some fun and all of that. What was the reaction from your clients on the SpaceX?
It's been it was exciting. Like a lot of people were calling and emailing saying, "Hey, we want to buy in at the $135 price." But interestingly, Ryan, there are many people as well that said, "I don't want this in my portfolio. I don't want it on the IPO. I want to know, in fact, will my index positions, will my ETF positions be owning the stock?"
Really?
Yeah. I've never seen
Is it
anything
like a political thing?
Yeah.
Are you kidding me?
It is. Yeah, it is.
You know, I always I've been talking about there's the old phrase, all politics is local. I said that phrase is kind of out the window. All politics is national now. Everything is seen through this national political lens, even down to your personal investment fund.
Yeah. So here's the deal. Okay. The NASDAQ ETFs, they're including SpaceX very quickly. Okay. Whereas the S&P index-based funds, they're going to be more like the end of the year.
Mm-hmm.
And so, are you really going to change your whole portfolio because of this one company? Most likely not.
Some people are, though. Is that what you're saying?
Some people are asking. I'll say that.
Unbelievable.
Right? Yeah.
That is incredible.
It's unique. It's I've never seen anything like this before.
Can I ask you a question about this? Because, so SpaceX goes public, IPO, $135. That's the advertised price. But then you look, you're trying to buy in, it's like $150. Who gets the $135?
So when you have an IPO the night before, if you're a brokerage firm, it has an allocation, you can get in on that $135 price. Like Schwab had that opportunity, okay? But a lot of other broker dealers didn't. They were having to purchase the next day on the open. And it did open at like $150, like you said, but within seconds it was $160.
Right. Didn't get up to like $175. I mean, it has come back.
It went up to like $220.
Yeah. What do you make of that? Do you think that part is political too?
No, I think that's the excitement.
Yeah.
I mean, it's a pretty interesting company, right? You could see how people are excited about the prospects, but the price, and this is not advice one way or another, but it was a richly valued company. It reminds me of 1999. Right? We've talked about that before. But now the price has come down dramatically. Like you could purchase it for way less than $220. And Jim, there's some stats about IPOs though, right? We got to be aware of.
Yeah, I think that was one of the interesting things to come out of this is there's been a lot of high profile IPOs over the last several years, going back to like Facebook and some of these all the way to, some of the Bitcoin stuff. And there's just tons of these high profile companies that have come public. And while great companies, that hasn't always meant good things for the stock price. So we we see that of these major IPOs, not, weeding out the little ones, but of the major ones, within 1 year's time, typical drawdown, meaning peak to trough on it, has been like 55%.
Really?
So we've seen a lot of volatility in recent IPOs, in the big ones especially.
This one in particular intrigues me just because, I mean, this is space tourism. I mean, we're literally talking about something that completely we've never seen anything quite like it. I mean, the ability to go up, take a look at Earth, maybe go to Mars one day. I mean, the prospects of what the company has done over the years, but could be and could lead to ultimately this interplanetary civilization makes me excited about it at least a little bit. I mean, I'm not in on it, absolutely looking at it though, to see where it goes, but it's a very interesting company.
Yeah, and there's the Starlink component as well, which they say as a standalone company is huge already. My kids are complaining about my home internet.
Oh, mine's terrible too.
And the ping, and I'm like, I don't know what that is.
Yeah.
But they're like, we need to switch to Starlink. And I'm like, well, guys, we got a gig speed right now. Starlink is only 200 megabytes per second. And you got to get like a satellite dish. And I'm like, who's going to put up the dish? I'm not climbing on the roof,
Right.
So, but a lot of people who have, boats and RVs and they're in rural areas, Starlink, that's huge.
It's pretty incredible. You had mentioned that, so many stocks so many IPOs in their first year drop 50%. That would probably, take SpaceX to just north of $100 a share. And so you're losing money early. Is that why people would wait? And, so much of stocks, obviously the company's got to be strong and everything like that, a good product, a good employee base, smart people leading the company. But aside from that, excitement and the way you feel about a company really drives that price too, does it not?
I think we saw that after the IPO from 135 up to 220.
Mm-hmm.
And then what we see is the excitement wanes a little bit. Some of the employee lockup starts to expire. So if you worked there, you could start selling your shares at that point.
Mm-hmm.
And then, that's when the hangover starts, right? And so that's how you could see the price go from 220 to 110 sometime over the next several months. I'm not predicting that it will, but history tells us that there's a strong possibility that could be the case. So I was counseling people to say, let's be patient and let's just see what happens. Let's not get too emotional.
Heaven forbid, right? We always got to react.
Yeah.
We always got to react. I mean, that is the smart advice, if you can call it advice. It is be patient. Everybody wants to react right now. Be patient. See what happens. What do you think of that, Jim?
Yeah, I think that's good advice. If you really think the stock's going to 1,000, does it matter if you got in at 165 or 185? Just kind of see how it shakes out.
Let me ask you quickly, guys, about just, so much has been made about all the millionaires and the employees at SpaceX, from the people that worked in the cafeteria to the engineers that were paid in shares instead of big raises monetarily. It worked in their benefit. They're now millionaires. I saw an interview with a custodial engineer that is now worth $800,000. And he was crying, and it was great and all of that. What would you say to somebody who works at a company like that when you're faced with this prospect of ownership shares, company, shares in a company, or, take your big raise because you are fighting for every dollar? If you're making $25 an hour, chances are you're up against it every month probably.
Mm-hmm.
It's hard to see that far out.
It's a good question. I think if you work for a young venture growing company like that, it makes sense to redirect some money, some money from the salary or from the hourly into that investment account or the stock. If you work for larger, more established companies, usually they have more traditional plans set up. You could buy it in the 401, or you could buy a stock purchase plan at maybe a 10 or a 15% discount to the public price. I love that as well. So I'm all in. I'm all for it. The issue now with the SpaceX shareholders, they're concentrated, right? They have maybe all their net worth tied up in SpaceX stock, and that could be a problem.
We are talking to Nick Hopwood, the president, Jim Pilat, the vice president of Peak Wealth Management. You can find them at peakwm.com/WJR. 760 WJR. It is no lazy money. We hope you enjoy this episode tonight with our friends from Peak Wealth Management. You can find them at peakwm.com/WJR. Nick Hopwood is the president, Jim Pilat, the vice president. Gentlemen, if you look at your watch, if you look at the calendar, it says July 1. Midyear, baby. Let's go. How are we doing here? A mid-year review.
Yeah, I think it was a great first half. We saw some volatility with the Iran conflict, but overall, a great first half, kind of on pace to match last year's gains. So it's always a great time, like this milestone, like Jim said earlier, at the halfway point, happens to be today, right? Reevaluate everything. So we'd like to start with our year-to-date returns. So how did you do with your portfolio? Let's re-examine your risk and make sure the portfolio risk looks good. And if something looks off, now is the time to address it.
What are you looking for in terms of a return on it? Like, is there an eyeball number that you're looking at?
Well, it depends on your risk tolerance and your risk profile.
I guess you're right there.
But yeah, we look at the indexes. We're going to look at the U.S. index, the international index, the fixed income index.
Mm-hmm.
And depending on if you're aggressive, you're going to compare to stocks. If you're conservative, you're going to compare more to bonds. Mm. And if you're in the middle, a blend.
I think that's an important thing to point out, though, is so often people will compare their portfolio to the S&P because the S&P is the standard benchmark. Well, they might not be invested anything close to the S&P. Their risk tolerance might not even be close to the S&P. So using it as a benchmark is really unfair. And I think that's something that comes up all the time. People want S&P-like returns with balanced allocation risk. You know what I mean?
I do.
You really have to understand that.
I do. And I'm going to give an off-the-wall analogy of something like that. I was talking to somebody from a card show earlier this week, and some of these cards are worth thousands, tens of thousands of dollars. And everybody thinks just because they have an old shoebox in the basement that their cards are worth $20,000. Just because the S&P might be hitting a 10% return doesn't mean your investment fund is hitting a 10% return if you don't have that card, so to speak.
It's funny you mentioned that because my brother took his shoebox in. And the guy at the car dealer said, "You have to pay me to take these. They were worthless."
Isn't that something?
Yeah, I couldn't believe it. I figured my box is worth a fortune.
Right,
too, right?
Exactly. But I think so many people think their investment. Why is my investment portfolio not looking like what I'm seeing on the news, or what I'm seeing reflect on a daily basis in the S&P or the NASDAQ?
Starts with risk, like Jim said, and then secondly, if you're owning the index, it should track the index. If you're owning an actively managed fund and it's not keeping up, you have to ask why, right? Do a little digging, and if the explanation doesn't justify the returns, then maybe you need to put it on the watch list.
You mentioned the war with Iran earlier this year, and at the end of February, early March, and I think there was a lot of trepidation in terms of the economy and investments moving forward for the end of the year. I mean, that was back in March, and I know there was a lot of tenuous moments for shareholders' investments all over the country. Man, we've bounced back already in that 3-month period. It is incredible, and that is why, and I think one of your, after talking to you for several months now, one of your main themes of your message is patience.
Yeah, absolutely.
You can't overreact to the daily news cycle, basically.
Ryan, March was awful. Mm-hmm. Okay, we had a decent January and February, and things were looking nice for the first quarter, but the Iran situation sent the S&P down about 10%, NASDAQ a little more, but April bounced back. It was the second best April ever.
Yeah.
Okay, and so if you panicked and shot yourself in the foot, you missed that rebound. Second quarter was excellent, and so I just feel like you said, you do need to be patient. You have to have a plan for when those drawdowns come and ask yourself, when the next correction is here. It could be July.
Right.
We don't know.
Patience might not be the right word, but you just simply can't react to the daily news cycle.
Yeah, and I think that's what's interesting about this first half snapshot that we have is that we did have a really bad stretch. That March was really bad, and you got to think back to how you felt during that period. And if you didn't like it, and if you either shot yourself in the foot, panicked, got out, that's, you don't have the risk tolerance to be all in the S&P, right? So then that's where a good example of why you wouldn't allocate that way or track your performance against that.
If you took action in the first half of the year and now you're underperforming as a result, you have to examine why and how am I going to be different next time, right? To learn from a mistake.
That is absolutely the case. Talking to Nick Hopwood, the president, Jim Pilat, the vice president, Peak Wealth Management, peakwm.com/WJR. They do have a free offer. You can email nick@peakwm.com. You're going to get a free Roth conversion analysis. Also, Jim@peakwm.com. He'll give you the free. I'm farming you out here, Jim.
Yeah, go for it.
Free Roth conversion analysis.
Ryan, the next thing to think about, mid-year is, am I on track to max out? A lot of people, they set it and forget it, or maybe they made a change and promised themselves they were going to increase the percentage back up, and then they forget. So this is a public safety announcement, public service announcement,
and safety.
Yeah,
for your financial safety.
There you go.
Let's get back on track. And look, just this morning we were having a meeting with a prospect, and he said he's turning 50 this year. Well, guess what? He didn't know that he could take advantage of the catch-up contribution all year long because he's turning 50 in December.
Does that happen at 50?
Yes.
I didn't.
The year that you turned 50.
Wow, that's interesting. I mean, I didn't even.
So he can change his allocations and get it's like an extra $8,000 or something into his 401 this year. And also, did you do your backdoor Roth IRA? Are you on track to max out your HSA? And all of these limits are increasing every year, thankfully. They're all indexed to inflation. And so you got to keep on top of it every year. Usually we tell people in January, hey, make sure you adjust it. But if you didn't, you still have time to do it for this year.
One of the things that's important is we just make a note of where we are mid-year too. Is it's good time to review your beneficiaries. Those can change, and you can you can forget about a lot of things, right?
Yeah, you get married, you get divorced, you have a baby, right? All these things happen. Interestingly, Ryan, there's so many people who have estranged children.
Yeah,
it's remarkable,
isn't it?
So I'm always asking in every single meeting we have, here's your list of beneficiaries, here's your primary, here's your contingent. Do we need to make any changes?
Being in the news business, I feel like I see quite a bit of that just story out there. It's an incredible piece, but a good reminder to review your beneficiaries.
Yeah, there's always some really wild stories out there about how money got left to a girlfriend from 20 years ago and stuff like that. So it's remarkable.
And review cost of living.
Wow, Ryan, this is a good one because so many people have no idea how much they spend, and they're not being honest with themselves, right? If you have a great income, maybe you don't need to track every dollar, right? But you have to have a sense of what your cost of living is because that's your target, that's your goal for your retirement standard of living. No one wants to retire to a lesser cost of living than they have now. So what is that? So we can plan for it. Now, a lot of times people have no clue, so we have to kind of come at it from the back door and say, what's your take-home pay? Maybe that can be our goal for retirement if they don't have any, expense tracking experience.
That's a good way to do it.
Yeah, and I think, on that topic, expense tracking is really one of the best things I think anybody can do. Usually people think, well, if you're not doing well and you're pinching pennies, you got to track expenses or make a budget. But even if you are doing well and you got plenty of extra, there's a ton of value in tracking your expenses. And you can wait and do it, halfway point of the year maybe is a good time to think about it. But I encourage people to do it every month. Mm-hmm. Every single month I pay a bill, I put it on my expense tracking sheet. I know what I spend. I know where it's going. I can identify if a month looks, out of whack for some reason, dig deeper if I needed to figure out why. but I think it's one of the best things people can do to really be in tune with their financial situation.
It's great advice. Gentlemen, any final thoughts?
Well, let me piggyback on that and say, let's do a net worth statement for the mid-year and every month as well. We have a template on peakwm.com/expenses, just a simple spreadsheet that builds in that expense tracking sheet that Jim was mentioning and your net worth statement each month, and you can carry it forward forever. It's really rewarding every month today on the 1st when I update my net worth statement.
It's awesome.
Most of the time.
Absolutely right. Knock on wood. So how are we enjoying the heat wave that we're about to be in here? High 90s. Are you guys high 90s type of people? Because I really enjoyed the 70s. The high 70s, I
like
really enjoyed it. I'm not going to lie.
Yeah, 78 and up. That's my jam right there. Like, let's go on the boat. We can even pull some shade out on the Bimini, but let's float. Let's anchor. Let's float. You know, the water's like bath water. It's great.
So you have a boat, Nick, and it has come to my attention that the name of your boat is Emergency Fun.
Fun, yes. Now, look, people might be thinking this is like some sort of yacht. No. This is like a tri-tune, okay? It's a float boat, okay? But yeah, we had to come up with a fun name for it. Emergency Fun, similar to your emergency fund.
I love that.
Right? A little play on finance there.
I love that. Jim, do you have a boat, and do you have a fun name for the boat?
I actually do have one as well, and I kind of agree with you. If we could be 78 every day, I'd be happy. But when it gets to be in the mid 90s like that, the boat's the place to be. I haven't come up with a good name yet. Maybe I need to put my head together and come up with something good.
We'll be next month. Yeah.
How about Peak Fun?
That's good too. That's good
There you
too.
go.
What's that song? Finance Trust Fund 6'5" Blue Eyes.
Oh yeah,
So Jim's are you 6'5"?
6'4".
Okay, so 6'4", brown eyes.
There you go.
6'4"
Yeah.
brown
I'm checking a
eyes.
few of the boxes.
That is fantastic. Gentlemen, happy 4th to you.
Happy 4th.
All the best
Thanks,
to
you
you
too.
and your families.
You as well.
As we move closer to July 4th at America 250, hopefully everybody has a great week of fun and celebration, and be careful with those fireworks, ladies and gentlemen, and make sure those kids are safe as well. If you'd like to get in touch with Nick or Jim, you have their emails, nick@peakwm.com or jim@peakwm.com. You're going to get a free Roth conversion analysis, or you can just hit them up on anything you want to discuss with them. This is Peak Wealth Management, and this, my friends, is no lazy money here on 760 WJR.